Today's episode is brought to you by Fiscal.ai. Fiscal is running a Black Friday special, and now through December 1st, you can get 30% off any Fiscal plan. Let's get into it. Max, today we're talking about the most important topic in macro. And Max, I don't think this is the most important topic just in 2025. I think this is the most important topic that has happened in macro event, really, in the past 5, maybe 10 years.
Jack, you have my interest piqued. What is this big macro event?
Michael Burry launching his Substack. This is the much predicted event. He said November 25th, 24th, whatever is going to be a day that you won't forget, and we haven't forgotten it. He's quickly rising up the charts. Max, I think in all seriousness, his analysis is something that has been contributing to the discourse. Really, I think the person to first bring it to the foray in greater detail would be Jim Chanos. Basically, the argument that AI companies are artificially boosting their earnings by extending the weighted average lives of their depreciation schedule. So if they spend $100 billion on capital expenditures, they're taking a depreciation charge of $20 billion a year or 5 years. So 1/5 of 100 billion being 20 billion. So they're taking a $20 billion depreciation charge. Really, they should be taking a 33 or $50 billion depreciation charge because the actual weighted life is 2 or 3 years. Now, Michael Burry has pointed out in his Substack and his research that the weighted average lives have extended from 2 to 3 years to now 5, and in some cases even 6 years. The argument being that this is not true. If AI is this truly revolutionary technology, these chips are going to be kind of useless in 5 or 6 years. And even if they can be utilized, they're not going to have nearly as much value as they have right now. So that argument, I don't know if it's original to Michael Burry. I think it is, I'd seen Jim Chanos honestly get in more detail about it. And I'm actually going to be interviewing Jim Chanos later in December. So I'm going to be speaking to the kind of original source there. Max, what do you make of this argument, Max? I think there's some truth to it, but I have some issues with it.
I don't necessarily disagree with the argument so much as whether it matters to the price of the stock for right now. As you said in our last discussion, these tech scions think that they're building a digital god. And in many ways, like, the math doesn't quite work out unless you believe that. And so whether they're depreciating these assets at 3 years or 8 years or whatever is not exactly relevant to that question.
There's a lot of skeptical arguments about AI and about the return on invested capital. I think the most valid of these center around OpenAI, which is not publicly traded. It's a venture capital backed company that raised money at a valuation of $500 billion. The FT reported that HSBC, the bank, had projections about OpenAI's revenues, how the OpenAI's revenues were going to skyrocket, but that the losses would be quite extreme. We'll show some numbers on that later. But I think that the kind of center of the bubble, if this is a bubble, is not Nvidia. They're selling things to companies that may not get a good return on their investment. Maybe that's the left tail risk. I think the right tail risk is that these things, intelligence is achieved and no one has a job. I mean, that is maybe not a risk for the stock market, but that is a huge risk for society. So, like the Federal Reserve, it's all about a balance of risks. And there's a left side risk, the right side risk. The right side risk, good for stocks, not good for society. Obviously, we would like an ideal where it's not a financial bubble that implodes. It's also not so transformational technology that no one has a job and wealth inequality skyrockets, even more than it has. I just think that Michael Burry's criticism of Nvidia that's not where that the purchases are being made. Nvidia are selling the things that it may be a mistake to buy. Like, why not short the things that are making the mistakes of buying them? The reality is, Microsoft and Google and Amazon, they make so much money that shorting them is kind of a challenge because they're so profitable and they're financing their purchases mostly with free cash flow. They're moving towards the debt markets, but it's so early, Max. Like, you can see in two worlds a world where the hyperscalers have borrowed $500 billion to finance these purchases that maybe they are ridiculous, but like, we're just not there yet. It can get so much bigger, I think.
I think the argument you would make for why Nvidia is the company to short is, up until this point, we've been talking about Nvidia and their semiconductor business as if semiconductors are not historically a cyclical sector. And right now, it looks like it's an entirely secular trend. But eventually, we might settle into something that looks more traditionally like a cyclical semiconductor company. And companies that are cyclical do not command the types of multiples that companies that have steady, predictable earnings do. And if these companies which are making these purchases have to be more thoughtful about just dumping the money in, like the arms race ends, and it's about, can we get a good return on our investment? Is Nvidia's revenue line going to look as up and to the right? Is their profit going to look as up and to the right as it does now? And so I feel pretty strongly that Google's business is going to be around, that Microsoft's business is going to be around, but this is Nvidia's only business. And if that changes, then the company that is maybe the most overvalued would be Nvidia.
It's not their only business, but yeah, over 90% of the revenues are from the data set, maybe over 80% of the revenues. Yeah, yeah.
Ostensibly their only business. It's the only business that matters to the to the price of the stock.
Yes, Max, I take issue with, cyclical, not that it's not in theory, but in practice, because the implication is you can predict cycles very easily and just you wanna short the aluminum companies when the price of aluminum is at its peak, and you wanna buy them when it's losing money over the past trailing 12 months. Like, these things are really uh, hard to predict. And I just think, and Matt, here is a point. I think that I see runway for continued growth over the next 12 months. Just my read. Here's something I did find valuable from Michael Burry about he talked about how in late 99 and 2000 how all the CEOs were saying the demand is so strong and we see so much buying, the purchases are insane. We can't meet demand enough. And so that actually is what you're hearing now. So I guess it is possible that this is kind of the top in share prices and in revenues. That's just not my hunch. And also, Max, just like when I look at stocks to short, I think Palantir is a much better short idea than Nvidia, to be honest. But like there's these all these fake quantum computing companies. There are these uh um electric airplane companies that are losing billions of dollars a year. There's all these, fraudulent like companies that are going public and being promoted. It's like the best short idea you have is the most profitable company of all time.
He's the big short guy. He's that's what he does, right? It's not the little short, it's not the obvious short, it's the big short. And that's why he's number 4 on Finance Substack's, list. He could, if he wrote up a $500 million market cap company that's over-earning or is a fraud or whatever, we wouldn't be talking about it. That there's a reason that he picked it and he's called his shot here, and it's because it is, as you said before, it's the most, facetiously, we were joking about, Michael Burry launching his Substack as being the biggest macro event, but this is the biggest macro question. It is the biggest question in the
Yeah.
market, right? So that's why he's doing this, because it's the only thing that matters.
But in 2005 and 2006, he was right. That's the difference.
All you've said so far is that you think it's wrong. Like, what are the specific parts of his analysis that you disagree with?
He criticized Nvidia's stock buybacks. He said since the beginning of 2018, Nvidia earned about $205 billion of net income and 188 billion of free cash flow, assuming all capital expenditures was growth capital expenditure. So share-based compensation amounted to $20.5 billion. So it bought $112 billion worth of stock, and yet there are $47 million more shares outstanding. Like you can just show two charts, Max, that I made really quickly, just showing why this is the case. Yes, Nvidia since 2018 has spent more money on share repurchases than it has spent on share-based compensation. So you would expect that the share count has gone down, but it hasn't. It has actually gone up, or it's basically flat. The reason is the share repurchases were done starting, in scale starting in 2022 when the stock was way higher than it was in 2018. So it issued shares in 2017 and 2018 at a valuation that was way cheaper than it is now. So even though it is doing way more buybacks than it is now, it's at a much higher valuation. So, but I mean, look, and Jensen Huang was giving the people to whom Jensen Huang was giving shares in 2017 and 2018, 2019, 2020. They're probably extremely talented engineers and other professionals who have made Nvidia what it is. So I just think that that's a like a nonsense criticism.
Interestingly, management did respond. Generally, you would expect a sort of like direct public response, but in this case, they responded via some back channels going to the sell side analysts that cover NVIDIA and addressing Michael Burry's points sort of one by one. There are some people who commented that responding to Burry is like beneath a company like that. Like Microsoft wouldn't respond to claims about its business. Google wouldn't respond to this type of claim about its business. And if it did, it would do so, in a formal filing versus a back channel. I mean, did you think that the way they have handled Burry's writing has raised any red flags?
I think I would have liked to see this be public. The memo that you're referring to should have been issued publicly, but that memo itself was actually, I would consider excellent. There was a tweet, not relative to Michael Burry, but relative to Google, and that I think indicates a little bit of insecurity. But I say, look, insecure people, their insecurity often drives them to like rule the world and dominate markets. So I don't think there's a real signal there. Back, so I'll just, I guess I take your criticism that I haven't swatted down the things, but it's just like, okay, the circular financing that's a real thing, but accounts receivable growth indicates that customers are not paying. Like as you grow your business, your accounts receivable grow, and um, you have accounts where you can book the revenue, but you haven't received the cash yet, and you have days sales outstanding or DSO that it's pretty standard, where it's normal to give like trade credit to customers. It's not really even credit. It's just a very normal business practice. Inventory growth, I think there, I don't have enough clarity as to whether they're playing games or not. I think that the inventory quarter over quarter did increase 32% year over year, and often that is found at the scene of the crime of like accounting frauds. But I wouldn't say that I have a strong view on that either way. Cash flow conversions indicates low quality of earnings. I mean, Nvidia's free cash flow relative to its net income has always been very high. Uh, that deteriorated in the most recent quarter, but I don't think that's enough of a signal, honestly. And then, okay, the circular financing is an unsustainable business practice. This, I think, is a real thing. I think it's done mostly outside of Nvidia, and I also think that Nvidia's response didn't take into account the $100 billion announced deal with OpenAI, admittedly, because they haven't realized it in an accounting sense, and I don't think that is super binding based on what they came out in the super call in their most recent call. What's unsustainable about the financing is not so much that it's circular, but that it's coming from venture capitalists who are ultimately funding unprofitable activity. This is a criticism that I think the AI startups are losing money. So there are companies like Anthropic, but mainly OpenAI, that are just losing a lot of money on the compute that they're buying from the hyperscalers, Microsoft, Oracle, Google, and the like. And that I think is unsustainable, and it's reliant upon future injections of venture capital liquidity. Um, I mean, yeah, it depends. Can Sam Altman like raise $100 billion in 2026 from the Saudi Public Investment Fund and other extremely large institutional investors? That I don't have a view on, but if OpenAI is no longer able to raise capital, that is a much bigger threat than yeah, I'd say anything Michael Burry has written about. And I think that we can put actually some charts on the FT. And again, I have a lot of respect for Michael Burry as an analyst and as a figure in financial history and the great financial crisis. But when it comes to um, like specifics and projections, there are a lot of other analysis that am paying frankly more attention to. For example, Dylan Patel, who I would say there are people more bullish on AI than Dylan Patel, but relative to a lot of financial folks and people on Wall Street, he is seen as an AI bull. I am amazed by his detail and his command of the facts, and that is why, like, Mark Zuckerberg and Satya Nadella of Microsoft listen to him. And he's a young guy, super impressive, and he's really done the work, and he knows things and has data that other people don't have. In the same way, Michael Burry in like 2006 knew things that other people didn't know, and that was such a huge advantage. I feel like in the Michael Burry piece so far, it's not so much a ton of new information.
What you're saying is in the GFC, Michael Burry had the smoking loan. Like, he went
Yeah.
through all of these, CMBS, and he went through and he looked at these things on, like, an individual loan level and was like, "Holy crap, this is filled with complete shit." Like, in this case, like, all of the stuff that he's looking at, it are things that you could get from public filings, that you could get. I mean, obviously, that information was public before too.
Things I saw Jim Chanos tweet about 7 months ago. Like, Max, for example, so I did an interview with Bill Moreland, who's incredibly in the weeds on bank financials from the FDIC, and, I consider myself something of a banks guy, and I read the 10-Q and the quarterly presentations, and he refers to those as merely press releases and, PR events. So that he's like, the real data comes from the FDIC call reports. And, so he, in reference to a large bank, people can watch the interview and see what bank it was. He was like, "Oh, there was a $300 million loan that during the summer got reclassified from this category to this category." Like, that's the level of granularity that I think if you're going to have an edge in making a huge macro call that you're going to prove everyone else wrong, you should be, on that kind of granularity. I see that from Dylan Patel, who's a massive bull, and people, particularly in Silicon Valley, have a lot of respect for him. I have a lot of respect for him. Um, and I'm just not seeing a ton that's new from Michael Burry, but he's only posted 3 things. I'm sure he's got a lot in his sleeve. So I'm excited to see what analysis he has. And I also say, Max, I'd love to interview Michael Burry on this program, and I'd very, very interested in what he has to say. I mean, he is an extremely intelligent person and investor and analyst, and there's definitely no doubt about that. And Max, as someone who, we're at a small business and, we don't have a Bloomberg terminal, but we have a subscription to the Fiscal.ai, and that has really, really been helpful to analyze this self. So I'm a believer in doing your own analysis. And that's why I'm really happy to say that Fiscal.ai is a partner of ours. And normally, Monetary Matters listeners can get a discount of, I believe, 15%. But now, because it's Black Friday for a limited time, you can get off 30% off any paid plan. So right now, Fiscal is offering the biggest ever Black Friday discount. That's massive savings, especially for professional investors taking advantage of the enterprise plan. With this Black Friday discount, the enterprise tier comes out to less than $1,700 per year. That's less than 1/10 the cost of a Bloomberg, which much of the same stock market data. And Max, I'm just going to say that there are so many investors who have, small to medium to even large investment partnerships where almost all of what they invest in is stocks, and yet they're paying for a Bloomberg terminal, which has all this, data on cross-currency basis swaps and bond data and currencies, but like really all they want is stocks. Like, Fiscal AI is the product for them. And again, on this data, you can download the data because Fiscal actually owns the data. Instead of using huge workforces outside of the US to manually input data, Fiscal is using new AI technology to gather data directly from corporate filings, making it cheaper and faster than the labor-intensive incumbent. That's also why Fiscal's data is updated within minutes of corporate's earnings releases. And Max, you and I have seen that throughout this earnings seasons, first in the US, and now China is doing its earnings releases. And everyone, this deal won't last long, I believe until December 1st. So use the link in the description to get 30% off today. Let's get back into it. So, Max, I want to talk about this HSBC report on OpenAI and just use some projections. So, let's start with the good news, okay? The good news is that HSBC projects OpenAI's revenue to go from 13 billion in 2025, 12.5 billion to 35 billion in 2026, 67 billion in 2027, and then all the way up to 214 billion in 2030. That sounds amazing, Max. And any venture capitalist who invests in a company that, scales its revenue from 0 to 1 billion to 13 billion and then $213 billion, I mean, would be happy, right? Okay, here's the issue. HSBC is projecting enormous losses. In 2025, this year, it projects that the operating loss on 12.5 billion of revenue is going to be 17.7 billion. In 2026, operating is going to lose $80 billion a year. 2027, $104 billion a year. 2028, $108 billion a year. 2029, also $108 billion a year. And only in 2030 do its losses begin to go down. So in 2030, it's only losing $76 billion a year. So, I mean, Max, I know venture capitalists are used to losing money for a ridiculously long amount of time. And I think that public market investors would punish that losing money for such a long time. And frankly, I'm more of the public market side. Like, I think if Uber was publicly traded in 2014, the public, the all the people who would own Uber would have a tough time, and it would not have subsidized the losses as lavishly as the venture capitalists did. However, look, the VCs were kind of right eventually. I mean, I think Jim Chanos' argument about Uber losing money, he was right on the fundamentals for like 7 years. What more do you want? It's just that the VCs had a very long time horizon, and they were able to unload that on public markets at 2019. And for a very long time, Uber was trading below its IPO price. And now I believe it is trading above its IPO price. So, hey, look, the VCs, I guess eventually, they do get some stuff right. But Max, are the VCs this willing to subsidize losses? Are they basically willing to lose $500 billion or invest in a company that is going to lose in cumulative terms close to $500 billion up until 2030? And I mean, Max, the HSBC, I don't think they had a forecast for 2032, but what if they're still losing money in 2032? What about 2033? So this is where I think the wheels could really come off this train. And if AI is a bubble, I think that the eye of the storm of the bubble hurricane is OpenAI, not Nvidia. I mean, Nvidia will be affected. Everyone will be affected. When a bubble pops, anyone associated with it, no one is really spared. But I have much more concerns about OpenAI than I do Nvidia, and particularly like Oracle. I think this is why Oracle is going down. They have a huge hundreds of billion-dollar deal RPO, remain performance obligations outstanding, and then it was real. I said this on the last show that like they're really they're by far their biggest client for that is OpenAI, and like how can OpenAI spend hundreds of billions of dollars if it's losing $50 billion in a year or projected to lose? So look, I mean, HSBC could be totally wrong, and Sam Altman could be totally right. I will say, Max, I don't want to attribute too much to like the podcast world, but I think probably the top in sort of AI stock market pricing was on or around the day when CEO of OpenAI Sam Altman went on the Brad Gerstner podcast alongside Satya Nadella and said like, what do you mean? Of course we can spend money. If you want to sell your shares, you can sell your shares. I wish OpenAI was publicly traded so that these shorts could lose money. And he was kind of sounding like those CEOs who trash short sellers. And generally, I think that if a CEO trashes short sellers, the stock and the business tends to not do very well. Two counterexamples: Palantir and Tesla. So Elon Musk and Alex Karp. I would say those are the exceptions that prove the rule. Like I don't know if there there are. I don't think there are that many other examples other than that. Like short sellers don't like to short companies that are high quality companies. They short them because they have severe issues. Which is why I'm questioning and challenging Michael Burry's short of Nvidia.
A lot of the AI bulls have pointed to is the dropping costs of inference, right? So that can make up, a huge percentage of the cost of operating for these AI companies, OpenAI, all the other startups you mentioned that are losing money, and those costs are going down. So the question I would have for those HSBC projections is what sort of inference costs are they projecting out there? Because if the trends continue, inference costs are going to continue to go down a lot. So if the models are getting better and the cost of running those models is going down, I don't know if they're going to lose as much money. I mean, I'm kind of playing the foil here, no matter which side you are on. But that would be the big question I would have about those HSBC projections.
Right, Max. And these are projections about operating losses, which I think include depreciation and amortization. Uh, the question is, can OpenAI be profitable from a cash from operations perspective? And then from a operating income or net income perspective, they still will lose money because of the depreciation. But could they still, be a cash generating company? That I don't think is revealed yet in the FT article about the HSBC forecast. I mean, look, HSBC forecast, like, it's not bearish about the TAM. They literally forecast that there will be 3 billion ChatGPT users by 2030. So it's not like they're saying this isn't going to grow, blah, 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 blah. They're saying even if the rosy forecasts happen, they're still going to be losing a lot of money. So Max, I don't really have clarity. And, I don't think a lot of people know the answer to that question. But yeah, these numbers do not look good. I will also say, Max, I spoke so highly of Dylan Patel, and to his credit, Michael Burry spoke very highly of Dwarkesh Patel, who wrote. He has a great podcast, mostly focusing on tech and AI. Dwarkesh had an interview with Dylan Patel and Satya Nadella, CEO of Microsoft, where they used one of Dylan's charts from SemiAnalysis, showing the revenues or the ARR for coding agents At the beginning of this year, Microsoft Copilot was at 600 billion ARR, and that was the vast majority of the market. Now it's doubled its ARRs to over $1 billion. But Claude Code is now also at $1 billion. Cursor is 800, $900 million. OpenAI Codex has grown as well to $600 million, and that growth has happened since the summer. So these things are growing really quickly. And Max, we've got a really intelligent audience, and I'm pleased that we have that audience. One thing the YouTube people have commented is like, Jack, where are the revenues? Where are the revenues? Okay, yes, of course, Nvidia has giant revenues and profits. Microsoft, Google, they have the hyperscalers. They have these revenues and profits from these things, although maybe not free cash flows. But where are the actual revenues from the actual thing, from OpenAI, from Claude, from all these VC-backed companies? And I think that's a totally fair criticism, and I agree with it. I would have agreed with it slightly more, however, before I saw this chart. I mean, this chart shows that the revenue growth is quite extreme. Now, Max, the question is even this growth not profitable, even on a gross margin basis? Like, even are you spending $3 billion to get $1 billion in revenue? Like, okay, losing billions of dollars is fine if the reason you're losing billions of dollars is because of your fixed costs, your HR, your general and administrative, and stuff like that. But if you're not profitable, and basically the more you sell, the more you lose, then you start to have some issues. I mean, that may be the case. So again, I'm not some like hyper AI bull. I just have a hard time seeing how like the VC investors do well and the public market investors do well. Like, Max, I feel like there's two worlds, and we're kind of in between this. There's the worlds of the extremely optimistic open AI evangelists who say super intelligence is going to be here in 3 years. So, and if you're an investor in OpenAI, you're going to become the world's next trillionaire, or and then there are the people more from the traditional Wall Street saying this is a bubble, et cetera, et cetera. It's like, obviously both of those can't happen at the same time, but I can't see the right tail scenario happening without Nvidia doing extremely well. And if the left tail scenario happens, like, I feel like the first losses are going to be these money losing VC backed companies, not Nvidia. So
It's all predicated off of the right tail. All of the spending, the arms race is predicated off of the right tail. So if and that's baked into the valuation, like 100%. So I don't know, Jack. I don't see how it escapes unscathed. We're definitely pricing in the right tail scenario into Nvidia, and there's a long time that we have until we determine whether that is the actual outcome. But the idea that Nvidia is going to escape unscathed if
when did
OpenAI
I say
turns
that?
out
When did I say that?
what?
When did I say it was going to escape unscathed?
I mean, I don't know about you, but 50% drawdown, 80% drawdown,
Sure. But that
I mean,
it could
that's
be
a
an
big deal.
80% drawdown from a double, and then the peak is in February 2027. And then all these AI bears who've been so wrong for 3 years now will continue to be wrong for 16 months. So they'll basically have been wrong for close to half a decade. And then when the bubble finally pops, they'll declare victory. And then no one will find intellectual fault with them, even though they should. It's like, it's a matter of timing, Max.
Yeah, it is a matter of timing.
Yeah, I'm just
That
I'm just saying that obviously there's a difference between your own trading and portfolio, whether it's for your own money or for other people's money. Shout out to your podcast, Max, and making public calls. Obviously, that is always going to be two different things and different return streams and the like. But I think, like, when Michael Burry has his puts on Palantir and Nvidia, and every day Nvidia and Palantir go up, or at least don't go down, he's losing money on that. I think if you're out there making these public calls, like, your reputation should suffer the same reputational drawdown. And look, obviously, all these huge AI bulls, their reputations are going to be destroyed if this bubble pops. I think, Max, you and I are kind of in the middle. I see the case both sides. I actually do think that, Max, that, like, I mean, some of these scenarios that are so rosy that are not priced into markets. Like, some people are describing scenarios of OpenAI where basically within 5 years all knowledge work gets automated. I think that if that scenario happens, like, Nvidia's revenue is going to be double what is currently priced in terms of earnings estimates. I'm not saying that's going to happen, but I do think there is more of a right tail that can be priced in.
Fair enough. Well, there's one thing I am definitely bullish on, and that is Michael Burry's place on the Substack finance leaderboard. I mean, he launched that thing, I think he originally said November 25th. I think it was faster than that. He got it out by like the beginning of this week, the 22nd, 23rd, something, and he's already up to number 4 on the leaderboard. So for all of those people who are concerned about the puts that have gone to put heaven for Michael Burry, I wouldn't be too concerned, because he's making it all back and then some. So I guess my question for you, Jack, having gone through what Michael Burry has written, is he going to be getting $39 a month from you?
Well, I did pay to read it this morning. I think it depends. If, like, everything he writes is just gonna be a repeat of the past 3 pieces, I think there could be a little bit of cancellation, but, you know, I think there are definitely people who could find value in the work. Max, I just, this is a macro show. I'll just point out to the macro, like, AI is just becoming so important to the macro, like, totally reasonable to see in 2026 that X AI spending, the economy would be in a recession, but that GDP figure is gonna be 3% real and 4% nominal, or 5% nominal, because of all this AI spending. And also, I'm not a specialist in GDP accounting and when things are realized, but there's so much money that is scheduled to be spent, like so much data center construction that is scheduled to actually happen, that is, has been paid for and stuff, but it's not actually, shovels in the ground yet. That, yeah, I think we got to get used to this world where a lot of people just view the economy as sucking, but the GDP figure is actually pretty good because of all this AI stuff.
All right, Jack, I know you wanted to keep it singularly focused on AI today. Is there anything else on your mind before we go?
Yeah, the December Fed meeting, what's being priced into markets is a much higher chance of cut than when we last spoke. It had gone as low as 25, 30% last week of a rate cut, but now it's as high as 85%. And 85% is quite close to 90%. And I've never seen something being priced at a 90% probability, a few weeks out, and it not actually happening. So looking like Fed rate cut is going to happen. Perhaps that is accompanied the renewed bull market we have in stocks as we sit here today. I was feeling a little bit unlucky or foolish, maybe, because when I did the interview with Fed Governor Stephen Myron, and he made this huge dove case, and then almost immediately after that, like the rate cut got priced out. So interesting to see the rate cut being priced back in. I think it's reasonable for them to cut. So just paying attention to that, and of course the shutdown is over, so we should be getting the labor markets for November in the December months. The labor market data that had been released so far actually was good, so it is kind of counterintuitive. I had to learn, okay, why is this cut being priced back in if the non-farm payroll number was so good? I guess it was because the unemployment rate budged up, and you had John Williams from the New York Fed say something pretty dovish, as I believe we covered last week. So, a little hard to read the Fed tea leaves, but looking like there's going to be a cut. Max, we'll leave it there. People should follow your show, Other People's Money, and my show, Monetary Matters. We've got a ton of great content. I'm speaking to Ahan, Prometheus, the Quant for quantitative macro. And then we're doing a China update on Michael Pettis, who has a lot to say on imbalances between saving and investment around the world, between China and the US and everywhere. So people should leave it there. And then also, please check out today's sponsor, Fiscal.ai, where you can take advantage of Fiscal.ai's Black Friday special at the link in the description. Now through December 1st, you can get 30% off any Fiscal plan, including their enterprise tier, specifically designed for professional investors. Thank you again, everyone, for watching. Until next time.